So October 10th, 2025, a day the crypto market just completely fell off a cliff. I mean, the floor just vanished, and everyone's been asking the same question. Why? Why that specific day? Well, there's this one popular theory that blames it all on a single, kind of quiet announcement. Let's dive in and see if that theory actually holds water.
First, you have to understand the sheer scale of this collapse. We're talking $19 billion. That's how much in leveraged long positions got completely wiped out in a single day. These are traders borrowing money to bet on prices going up, and they all got forced liquidated. This wasn't just a dip, it was literally the biggest forced deleveraging event in the entire history of crypto. Just staggering.
So that brings us back to the central question. Could one memo from a financial index provider really cause all that chaos? That's the theory we're going to investigate today. We'll look at the evidence, line up the suspects, and try to piece together what really went down. All right, to get what happened, we have to rewind the clock just a little bit to the moments right before the crash. Because let me tell you, the market was in a state of absolute euphoria, and the stage was perfectly set for some major fireworks.
To really feel the shock, you have to appreciate the setup. Just days before it all came crashing down, Bitcoin had just hit a brand new all-time high, around $126,000. Leverage was through the roof. Pretty much everyone was betting the party would just keep going. An environment like that is incredibly fragile. It's like a house of cards just waiting for a breeze.
And into that fragile environment steps our main suspect, MSCI. Now, if you don't know them, they're one of the world's biggest index providers, and on October 10th, they quietly published what they called a consultation paper that sent immediate shockwaves through a very specific corner of the market.
The paper was all about these companies called DATs, which stands for Digital Asset Treasury companies. The poster child for this is MicroStrategy, right? These are publicly traded companies whose whole business model is basically to raise money to buy and hold Bitcoin on their balance sheet. For a lot of stock market folks, they've become a super popular way to get crypto exposure without buying crypto directly.
So here's the bombshell. MSCI basically said, hey, wait a minute. If a company's main gig is just holding crypto, it's acting more like an investment fund than a regular company selling widgets. And their argument was, if that's the case, maybe they shouldn't be in our standard stock indexes. For companies like MicroStrategy, this was a giant flashing red warning light.
And to see why this was such a massive threat, you have to understand this incredibly powerful cycle they've been riding called the reflexive loop. It works like this. A company issues stock to raise cash, they use that cash to buy more Bitcoin, which makes their stock price and market cap go up. That gets them included in major indexes, which then forces passive funds to buy their stock, pushing the price even higher, which lets them issue more stock to buy even more Bitcoin. You see the loop? Well, MSCI was threatening to pull the plug on the whole thing.
Now, the timeline here is absolutely key. The proposal drops on October 10th, and the market reacts instantly. But look, the final decision isn't even due until mid-January, and any changes wouldn't happen until February. So what does that tell you? The crash was fueled by the fear of a future event, an outcome that's actually still up in the air.
So the MSCI memo seems like a pretty good suspect, right? An open and shut case. But what if it didn't act alone? It turns out October 10th was a very, very busy day, and there were several other powerful forces at play that created, well, a perfect storm.
Yeah, it turns out the storm was already brewing. On that exact same day, you had that record leverage flush we already talked about. But on top of that, a huge macro shock hit the system. The US escalated its trade war with China, and that rattled global markets everywhere. So you've got thin liquidity, sky-high valuations, a macro shock. You already had the perfect recipe for a crash. The MSCI memo was just like throwing a lit match into a room already filled with gasoline.
This chart also helps put the whole DATS thing into perspective. I mean, look, MicroStrategy is a huge player, holding around 650,000 Bitcoin. That's massive. But the combined spot ETFs represent an even bigger pipeline for demand, holding over 1 million Bitcoin. So yeah, disrupting the DATS is a really big deal, but it's not the only game in town when it comes to structural buying.
That said, the potential impact on these DAT stocks is very, very real. Analysts figure that if MSCI and other index providers go through with this, it could trigger up to $9 billion in forced selling of these specific stocks. That is not a trivial number. It's a major shock to those equities for sure. Okay, so we've got our main suspect and a list of accomplices. I think it's time we bring all the evidence together and deliver a verdict on what really caused the October 10th crash.
So you've got the simple theory versus the deeper reality. The simple theory blames everything on that one MSCI memo. But the deeper reality, it was a pileup. It was a major macro shock hitting a market that was already drowning in leverage, and the MSCI news just landed right on top of it, amplifying the whole chaotic mess.
You know, the best way to describe this whole thing is that the crash was overdetermined. What that means is there wasn't a single smoking gun. Instead, you had multiple really powerful forces all slamming into the market at the exact same time. Any one of them could have caused a problem on its own, but all of them together, a major crash became almost inevitable.
So we've basically solved the mystery of the crash, but the story isn't over, not by a long shot. That MSCI decision is still hanging out there. So let's look forward and think about what might happen depending on what they decide. And this brings us to a really fascinating paradox. In the short term, if MSCI decides to exclude these companies, it's almost certainly bearish for those specific stocks. You'll see forced selling. But think about it. In the medium term, the money that's leaving those stocks still wants Bitcoin exposure. So where does it go? It could just rotate right into the spot ETFs. So you could have a situation that's bad for DID stocks, but neutral, or maybe even bullish for Bitcoin itself. The wrapper changes, but the demand for the asset underneath, that stays.
And really, all of this leads to the most fundamental question. The real lesson here isn't about one index provider or one specific crash. It's about the complex, always changing machinery of modern markets. So the question for all of us looking forward is this. Do you believe the underlying demand for these scarce digital assets will keep growing, no matter which investment vehicle Wall Street happens to prefer this year or the next? Because ultimately, that's what's going to determine where we go from here.